Okay, folks, so I asked you in this section of the class to read a little bit about the stock exchanges, the stock markets, and I thought it might be helpful to discuss them a little bit, give you an idea of how they work and why they're important. The New York Stock Exchange, of course, is the most well-known stock exchange probably in the world. Goes back to 1792 in New York City. It's that great building with the great pillars and the American flag in front of it that you've all seen on the news. But that's only really a very small portion, in fact, of what the stock exchange is about. Relatively little trading actually goes on in that building. It's actually trading that's being done over computers all around the world that happen to get funneled through that building and some backup facilities. You can get an idea of how the stock exchange operates and how big it is if you go on their website at www.nyx.com. Lots and lots of good information to be found there. New York Stock Exchange is home to listings for many major and prestigious companies, Coca-Cola, Procter & Gamble, some foreign companies such as Toyota. They have about 8,000 companies that list there. And they do tend to be the most mature and most established companies in the world. Not all of them. You'll find, in fact, that you'll find competitors at another exchange, which is up the street in Times Square, and that's the NASDAQ exchange. NASDAQ doesn't have a building that's anywhere near as impressive as the New York Stock Exchange. That's because NASDAQ is a much younger stock exchange, only goes back to 1971, and NASDAQ is a bunch of computers talking to one another. There's not a physical trading floor as there is with the New York Stock Exchange. New York Stock Exchange actually began as a group of people coming together to trade stocks physically, and it evolved over time to be an electronic exchange, but they still hang on to that floor, that trading floor. NASDAQ didn't start with such a trading floor. It's a bunch of computers talking to one another. NASDAQ still is an important place. It tends to be home to a lot of tech startups as well as giants such as Apple and Microsoft that got their starts there and have decided that they want to stay there. I wanted to talk with you a little bit about the purpose of stock markets, why we have them to begin with. They are places where executives and owners of companies go to raise money to grow. That's the chief foremost purpose of the stock exchanges. You can get your money, if you want to grow your company, from lots of different sources. You can go to a bank and borrow it. You can issue bonds, which is a way of issuing debt to the public, borrowing the public's money. Or you can sell shares in your company to the public, take them on as fellow owners, if you will, and raise money that way. The process is called taking the companies public. It is the least expensive alternative compared with selling bonds and with borrowing money from the bank. And it means a very radical change in your operations. It means that the private owners are no longer the sole owners. They have oftentimes millions of other co-owners who are their shareholders. It also means that people who run the company, the executives, have to answer to shareholders, and they have to comply with a lot of rules and oversight from the Federal Securities Regulator, which is the Securities and Exchange Commission. It's a radically different way of operating. Stock markets are really important because so many of us own shares. We're talking about tens of millions of people who own shares, tens of millions of Americans, hundreds of millions of people, indeed billions around the world, who own shares in retirement funds or in personal savings. If you work for a company and it has a retirement fund for you, it's going to have some money invested in the stock market. So directly and indirectly, many of us are owners of stocks. The other thing that's important about stock markets is that they are indicators of the health of the economy. Really one indicator, if you will. Typically, when markets go down for a sustained period, that's a bad sign. It means investors are very pessimistic, and they have reason to be pessimistic because of a poor performance in the economy. The problem with that is that there are a lot of misses. There are a lot of times when the markets go into a slump for political reasons or other reasons. Dissatisfaction with the political system is a common one. But markets will go into a slump for other reasons than general economic depression or recession. In fact, the saying is that the stock markets have foretold 9 of the last 4 recessions, because there are a lot of misses. But nonetheless, it's fair to say they reflect investor sentiments about the future. And that's really a key fact to understand about stock markets. When people buy stocks, they are making a bet on the performance of a given company and the performance of the markets in the future. They are believing that the value of the share is going to grow, and they're optimistic about the growth of that company and about the economy in general. Your readings deal with the Dow Jones Industrial Average. It's an important barometer of the market's health. It's not the only barometer. It's not the biggest barometer. In fact, the S&P 500 is a much broader measure. It consists of 500 stocks. The Dow Jones Industrial Average really consists only of 30 stocks that are picked by the editors of Dow Jones at Wall Street Journal, in fact. But over time, the Dow Jones Industrial Average has been a pretty good measure of the stock market's health. Over time, it has really mirrored the performance of the S&P 500 as well. There's occasionally short-term disjunctions, if you will, where one goes one way and the other the other. But for the most part, it's a pretty good barometer, and that's why it's very, very much watched. The Dow Jones Industrial Average, of course, is not the same 30 stocks that it's been since its earliest days. They've made substitutions over time. Periodically, the editors meet and they decide whether a new company ought to be added to the Dow Jones Industrial Average or not. So there are changes that do reflect the economy, but by and large, it's a pretty good measure. And if you notice on this chart here, it is also a pretty good leading indicator of how the economy is going to perform. As I said, sometimes this can be a pretty good indicator of what's going to happen in the economy. Not always, but it oftentimes foretells recession. Each of these gray bars is a period of recession, and if you notice in advance of each of these, the markets have tended to decline, and then they declined even more as the recession wore on. The most dramatic, of course, is back in the Great Depression, back in the 29 to 30 to really 40, 35 period, or 36 period, if you can see it there. The Great Depression, by the way, actually, if you notice there, consisted of 2 recessions that were back to back, with a little bit of a pause in between. The market recovered and then it came back. So that whole period between roughly 1929 and 1939 is a pretty dismal period, although technically there was a recovery in the middle of it there. But you can see how the blue line has proceeded. Typically it reaches a high in advance of recession. That's a peak when everybody's feeling great about the economy, and then of course it falls off the cliff and we go into recession, and the markets respond appropriately. We've recently seen an all-time high in the Dow Jones Industrial Average. It made history. It eclipsed the high that it had gotten to back in 2007, before this last recession. It took a long time for it to come back. It's recently blown past 14,350. And who knows what the future holds. Obviously, people are feeling fairly optimistic about the performance of their companies, at least, if not about the performance of the economy in general. But it's a good sign that things are looking up. The great caution, of course, is that as the market scales great heights, so it will tend to come down. And at some point, the market will reach a peak again, and then it will come down. And that will be a pretty good indicator that the economy has slowed. Right now, we're not facing that. We're facing a period of growth, not particularly aggressive growth, as most of you found in doing your hard times research, but a period of growth, and the markets are reflecting that. Fascinating to watch them. Enjoy your readings about them. We'll talk next time about the commodities markets.